All right, today is Thursday, August 26th. This is a recap for the stock market activities today. Folks, it has been a rough day from the get-go, both from an economic and geopolitical perspective. A disastrous day, an extremely hard and rough day for all of us. We have a lot to talk about, so let's go ahead and not waste any more time. In focus tonight, we will talk about the situation in Afghanistan, of course, and the anticipation of what will come out of the mouth of the Fed Chairman Jerome Powell tomorrow regarding tapering. And we will also talk about the reality of inflation, not the hopes, not the wishes, not the dreams, reality. But first, let's start with the breaking news of the day.
To those who carried out this attack, as well as anyone who wishes America harm, know this: we will not forgive. We will not forget. We will hunt you down and make you pay.
As you might have been aware already, there has been a terrorist attack in Afghanistan targeting the airport in specific, costing many lives. And of course, we had an advanced warning that this disaster was about to happen from both the British and Australian intelligence agencies.
For the course of the week, the credibility of the reporting has reached the stage where we believe that there is a very imminent, highly lethal attack possible within Kabul. And as a consequence, we've had to change the travel advice to advise people not to come to the airport, indeed to move away from the airport, find a place of safety and away.
So far, the death toll stands at about 14 U.S. service members, mostly Marines, but we also have over 60 Afghan civilians killed, including women and children. And now we have a lot of doubt regarding the withdrawal and the ability of evacuating all U.S. citizens, allies, and refugees out of the airport. Matter of fact, other countries are also casting doubt they will be able to get their own citizens out of the country, including France, Germany, and the United Kingdom. This is a disaster of epic proportions. Yes, the President of the United States, Joe Biden, was dealt a bad hand to begin with because former President Donald Trump negotiated the deal. So President Biden inherited the deal and had to abide with it. Yet there is no excuse for the botched, disastrous departure from Afghanistan. It was a failed execution from the get-go, and now we have to live with the ramifications of this disastrous pullout. The President of the United States holds full responsibility. Now, the scope of this program is about the economy and financial markets, not geopolitical, but we have to talk about it. And the reason is we have a lot of implications because this is a fluid situation and it could morph into something a lot bigger than it is right now. And one cannot help but to draw similarities between the disastrous departure from Afghanistan after 20 years and the much anticipated departure of the Fed from financial markets. You see, Wall Street, the equities and real estate markets have been under so-called emergency support, so-called accommodation by the Federal Reserve since the financial crisis of 2008. The Fed has been propping up the market artificially via fake money printed out of thin air, racking up trillions and trillions of dollars in debt for the next generation to pay and deal with. Meanwhile, what are the results? Have we achieved anything at all? Any progress at all from this disastrous monetary policy for over a decade now? Have we achieved anything at all from over 20 years in Afghanistan? Of course not. Everything was unwinded within 20 days. We have lost everything. 2 decades lost in 20 days. Likewise, over a decade of the cocaine operation by the Fed propping up equities and real estate markets. Will all of that so-called progress get unwinded once the Fed removes the so-called accommodation policy and departures from financial markets? This is the $1 million question. We had an advance warning about the attack last night, yet we got hit anyways, and service members and innocent civilians died. They say they'll give us advanced warning regarding tapering when it comes to financial markets. But will the advanced warning serve anything at all? Because the moment tapering is announced, the intentions of tapering are announced, the market will suffer a hit and a withdrawal right away because the market has been a coke addict for the last 10 years plus. Of course, for now, the market is desensitized. The market doesn't care about anything at all. If this event happened in a normal market, the Dow Industrial Average will be down a minimum of 1,000 points. Not in this hypermania, hyper-bubble market, because the market is hooked up on steroids and drugs from the Federal Reserve. And that's all what the market cares about. Listen to CNBC analysts when they're asked about the events in Afghanistan today and the impacts on financial markets.
Let's check now on the markets at this hour. Our investment committee today is Courtney Gibson, Rob Sechin, Steve Weiss, John Najarian, co-founder of MarketRebellion.com. Let's look at some numbers, shall we? The markets, little changed really on this news out of Kabul. It's not that the market seems to be taking its cues from. We'll talk about that in a moment. But there you look at 5 of the market metrics. The Dow Industrial's about 0.1% lower, 0.2% for the S&P 500, NASDAQ again, little changed. Russell 2000 down about 0.5%. And there you see the yield on the 10-year note moving higher again at 1.35%. Of course, the federal. Welcome to all of you on the investment committee. Let me turn to you first, Steve Weiss, and get any thoughts you have about how what is going on in Kabul affects the investment landscape, if at all.
Tyler, good to have you back on the show.
Thank you.
I don't think it affects it at all. We saw a knee-jerk reaction down on news of the first explosion. I'd say that's typical. And I can't tell you if it's the algos that read the news stories that come out that sold it down or people that were worried. But anytime you see geopolitical incidents, it is always, and I repeat that, always a buying opportunity. This I would not put into that category because it just doesn't have any impact whatsoever on the markets. The human tragedy is, of course, another story, but this just doesn't figure into my thinking, nor should it figure into anybody else's. We're out of there. It's a different part of the world. It's not affecting our commerce, not affecting our import-exports, period. So that's how I see it.
Rob, do you digress at all from what Steve just said, or are you on the same page with Steve?
You know, I'm on the same page. It is another thing to worry about. It's probably something that you shouldn't worry about, to Steve's point. But the one thing about these markets is the more there is to worry about, the more when you remove those worries, markets can climb those walls of worry.
Of course, they're all totally divorced from any reality at all. These people come up every single day and they pump regardless of what's going on in the geopolitical arena, regarding the pandemic, regarding the economy, regarding earnings, regarding everything. Nothing matters at all. They're right, because what matters to the market right now is the Coke coming out of the Fed, and that's all. But perhaps we have a problem here when it comes to the Coke, because the assumption was, once the Jackson Hole meeting was canceled and announced to be held virtually, the assumption was, and perhaps still is, that the Fed will not taper as planned before in October. The plan was that tapering will be agreed on in the Jackson Hole meeting, and then tapering will be announced to us, the dummies, in September, but the Wall Streeters will get the announcement ahead of time, and then in October, the Fed starts tapering its assets purchasing programs. Yet the cancellation of Jackson Hole in person was a sign for the market that perhaps the Fed will hold on their tapering announcement due to the impact of Delta on the economy. And the symbolism of canceling Jackson Hole in person was the green light for the market to rally impulsively higher on Monday. Because once again, bad news is good news for the market. Why? Because bad news merits the Fed to continue their so-called accommodation, the so-called emergency policies in propping up the equities and real estate markets. But good news, such as the economic recovery, creating jobs, defeating the virus, all of these are bad news for the market because it makes the accommodation policy, the emergency policy, needed. We know that market valuations right now are far divorced from the fundamentals, far divorced from corporate earnings. And what propped up assets prices higher to be divorced from their fair prices was the monetary policy. So when the accommodation by the monetary policy is removed, specifically abruptly, the assumption is we will see what happened in Afghanistan taking place, symbolically speaking, in the financial market. And now the so-called optimism that we had earlier in the week, prompting the impulsive, irrational, out-of-whack market rally that we saw on Monday, is being under the microscope. And the reason is we heard from various Fed members, some voting, some non-voting members, but specifically from San Luis Fed President James Bullard. Now, we talked about Bullard in the past. We made fun of him that he smokes hash and he comes out high and he says the craziest things. Sometimes he'll be so high, he'll speak off cuff and tells the truth. But at least we can get some honesty and transparency from James Bullard.
Thanks, Stephen. Thanks for having me. This is, I think the words were hot, hot, hot. We have a lot of inflation in the U.S., more than we expected. If you look at something like core PCE inflation, that's excluding food and energy, measured from a year ago, it's running at about 3.5%. That's more than we expected. Last December, we were saying that number for all of 2021 would be 1.8%. So we're quite a bit higher than we expected. We do have a new framework. We did say that we would allow inflation to run above target for some time, but not this much above target. So I think a lot depends on whether inflation is going to moderate in 2022 or not. I'm a little skeptical that it is. I think we're going to get at least 2.5% inflation in 2022. Maybe higher than that, and there's some risk to the upside on that. So for that reason, I think we want to get going on taper, get the taper finished by the end of the first quarter next year, and then we can evaluate what the situation is. We'll be able to see at that point whether inflation has moderated, and in that case, we'll be in great shape. If it hasn't moderated, we're going to have to be more aggressive to contain inflation.
And it's not only Bullard, by the way, who is maintaining the hawkish stance. Now we have Kansas Fed President George, and she's also sounding the alarm that this inflation doesn't look like it is transitory at all. And perhaps it is time for the Fed to start to taper. Folks, we are now in August. The argument for transitory inflation is garbage. And it's done. It should be flushed down the toilet. We played this game. It could have been transitory all the way to June. But once we got in July and we got the same numbers, inflation continues to rise higher and higher and higher. And the transitory argument goes out of the window. Even with Delta tampering inflation expectations, inflation continues to be at elevated levels, perhaps moving the economy into the phenomena of stagflation. We also heard from President Kaplan of the Dallas Fed. Kaplan made headlines on Friday when he flip-flopped and said perhaps Delta merits a delay in tapering. Kaplan has been the king of hawks, spearheading the narrative of an early taper. But now we have another flip from Kaplan, going back to his original stance that the Fed should start tapering by October, suggesting that yes, Delta is a problem, yet not big enough, at least not right now, to slow down the pace of inflation, at least in a sustainable way. And perhaps the biggest news we got today is out of South Korea, because the central bank over there already announced raising interest rates. And this is the first major economy in the world to announce raising interest rates. So if you saw any weakness in the market today, it wasn't due to Afghanistan. It was due to Bullard, George, Kaplan, and South Korea. Because for now, this coked up market cares not about Afghanistan at all. They could have killed 500 troops and thousands of civilians, and the market would have reached all-time highs if it wasn't for the commentary from Bullard, George, and Kaplan, in addition to the news from South Korea in the morning. Now let's segue to inflation, because you cannot talk about tapering without presenting the reality of inflation. In any inflation phenomena, we have two dynamics: demand and supply. Inflation rises higher when demand surges and supply fails to keep up with the demand. Therefore, we have a shortage meriting an inflation phenomena. When inflation persists for too long, it leads to the phenomena of stagflation, when prices go too high, out of whack, slowing down the economic recovery, the pace of economic growth, and consumer spending. And perhaps we're already at this point right now, but this is not what I wanted to talk to you about in this video. What I wanted to present in this video is the reality of the demand and supply dynamics. A lot of people predicting deflation and perhaps a recession, yada, yada, yada. Consumer sentiment is down, consumer spending is down. Yet what you're not factoring in is the fact that COVID is becoming a stagflationary force. Why do I say that? Because we now know that COVID-19's impact on the demand dynamic varies, meaning you have a certain region that gets hit pretty hard, slowing down the demand in that particular region. But then we have other regions in the world not impacted by COVID, and the demand stays as is, if not growing, due to consumer behavior in anticipation of a COVID hit. Meanwhile, COVID-19's impact on supply remains constant. You don't see this variation like you see with the demand dynamic. Countries hit by COVID-19 and not hit by COVID-19 both suffer from the same impact on supply. Why is that? Well, part of it is the dependency on the supply chain from Asia, specifically from China and Vietnam. What do I mean by what I just said? Here's what I mean. This is the demand picture in the United States of America. We're getting hit by Delta, and Delta is slowing down the demand dynamic in the country. The number of travelers, according to the TSA gate count, is dropping down. We're seeing less traveling. We're seeing a rollover, where many people are canceling travel plans due to the fear of Delta. We're also seeing consumer credit card spending rolling over, be it spending in gas stations, lodging, airlines, or even entertainment. Consumers are not spending. They're slowing down the pace of spending. What does that mean? Demand goes down. This is all deflationary, right? Hold your horses. We're also seeing the number of reservations in restaurants rolling over, according to Open Table. But while all of this is going on in the United States, demand is slowing down. Consumption is slowing down. This is all deflationary, folks. In the meantime, in countries that have recovered from Delta, the likes of India, for example, we're seeing a surge in consumption. Be it flying for vacations, spending in gas stations, lodging, entertainment, restaurants, spending in general rising in the country of India. And therefore, while we have weakness in consumption from American consumers, for example, spending less on gas as people stay at home, they're not traveling as much, they're not going out for work, the demand for gas goes down, prompting crude oil prices to go down as well. But the Indian consumer is now spending more, and the demand for gas in India is rising higher. And therefore, we have this balance. The consumption in one country, in one region goes down, but then the consumption in other countries, other regions spike up higher, keeping a balance in the demand dynamic. But is the same happening in the supply dynamic, for example? The answer is no. We are now expecting the supply crunch to last all the way till the end of next year, as shipping rates soar to all-time highs. The ports are being shut down. Factories are being shut down. There is a shortage of labor across the globe. Factory workers are quitting jobs. They're not interested in working in these factories anymore. We had the Suez Canal crisis. All of that adds up, and we continue to see the supply dynamic and inflation with no relief in sight. And this is now impacting corporate America. You might have heard the conference call from Dollar Tree, for example, today. The stock was down big, and the reason is they're facing a lot of shortages. They're facing higher prices due to shipping rates. Likewise, we heard from Abercrombie & Fitch, indicating the same thing, that the shutdown of factories and ports over at Vietnam is impacting their inventory, impacting their prices. Those prices, higher prices, that the company has to pay will be passed down to the end customer, meaning you and I. Now, luckily for you and I, we don't wear tight t-shirts anymore, because we're not teenagers anymore. And I know what you're going to say. Oh, but I'm a teenager, bro. No, you're not. You're just a creep online. I know your ages, by the way, because YouTube shows me your ages. Most of you are in your 30s and 40s, by the way. So one would hope that you're not wearing one of those tight t-shirts anymore. But all jokes aside, the shutdown of ports over in Vietnam is also impacting Nike, Foot Locker, Adidas. All of these companies are complaining about the shortage, the shutdowns in factories and ports, not just in Vietnam, but also in China. But this is a clear illustration, by the way, that COVID-19 has become a stagflationary force. It has very little minimal impact on the demand dynamic, but it has a constant negative impact on the supply dynamic. And now we have shutdowns in the country of Vietnam. This is a country that has been spared from any wave of the COVID-19 virus last year. And this is the first and most aggressive wave that the country has dealt with before, therefore prompting the military to shut down ports, imposing lockdowns all over the country, from factories all the way to ports. So the supply chain over at Vietnam is gone, and this will have severe negative impacts on the flow of goods globally. Second to China, Vietnam is one of the biggest importers of goods across the globe, specifically to North America and the EU. So we are now stuck with this inflationary force that is morphing into a stagflationary force. And the Fed says, don't worry about it, this is a good thing because inflation will speed up the economic recovery, will create more jobs, will recover more jobs, will have a better economy if we speed up the pace of inflation. And rest assured, if inflation gets out of hand, we got the tools to deal with it. What are the tools, Mr. Powell? The tools are tapering and raising interest rates, meaning monetary tightening, less accommodation, removing the emergency policy. In other words, the cure is worse than the illness, and this misguided policy is now costing the American consumer. The Fed says inflation is good because it creates jobs. Their mandate is full employment and price stability, and to achieve the mandate of the Federal Reserve, they need inflation. Well, after trillions and trillions and trillions of dollars, where are the jobs, Mr. Powell? What is full employment, Mr. Powell? Where is price stability, Mr. Powell? Because contrary to your belief from initiating this reckless monetary policy and pushing inflation to rise higher, you're not helping the poor and the middle class. What you're doing is straining the budget of the poor and the middle class. And now we have average American households getting a double blow to their bank accounts. The banks are tightening on American consumers by canceling credit lines, lowering benefits on credit cards, lowering credit limits on the consumer. And on top of that, we have inflation, an added tax on the poor and middle class. Every dollar you deposit in your bank account is declining in value as we speak right now. Every hour, every minute, every second, your money is depreciating in value sitting in your bank account. But does the Fed cares at all? Of course not. Inflation is rising higher across the board for everyday goods. Car rental prices up 87.5%. Gasoline prices up 26%. Beef prices up 20%. Appliances prices up almost 19%. Fruits up 17%. Pork up 16%. Poultry up 12%, fish up 10%, electricity up 7%, even TV prices. Remember, but TVs are deflationary, bro. We got deflation because TV prices are down. Even TV prices up 7.5%. You also have haircut prices up 8%. You see all of these guys walking around with long hair, looking like cavemen. Well, haircuts are expensive. And what went down, by the way? Speaking of deflation, men's suits. Men's suits are down 20%. That's your deflationary force. Men suits. Luckily for me, of course, I like suits, and when I do the show in person, I will wear a suit. Add a professionalism and respect to my viewers. I treat you with professionalism. I don't show up with a sweatpant and my pajamas doing a show. So luckily for me, suit prices are going down. But ask yourself a question here. Do you eat men's suits every day, or do you consume fish, pork, beef, electricity, gas? All the important day-to-day expenses for the average American household are rising higher in price. So I ask you again, what is the purpose of the Fed's policy? What is the need for the so-called accommodation and emergency policy that the Fed has enacted since 2008 to prop up stocks and the real estate markets? Have we achieved anything that is tangible or sustainable from the Fed's policy in the last 10 years plus? Well, the only thing I can point out to is assets prices. The only thing that this policy, this reckless, misguided policy out of the Fed, the The only thing that it has achieved is propping up stock prices to cartoonish levels and propping up real estate values to cartoonish levels. Now, you could say that this is good for the average American household because we all have retirement accounts tied to the stock market and some of us are home owners. Yes, but the benefit is negligible. It's a side effect. Meanwhile, the main effect of this policy is making the rich richer because the majority ownership in the stock and real estate markets is held by the 1%. 1% of the country owns 99% of assets. But have we achieved any sustainable gains in employment, in wages, in the standard of living for the average American, or did we get more homelessness, more depreciation of our wages, and immediately when the crisis hit, the COVID-19 crisis, we lost millions and millions of jobs instantly. So all of these trillions and trillions and trillions of dollars that the Fed has enacted and pushed on Wall Street and the ruling class since the 2008 crisis did not sustain or prevent the loss of jobs at the first hint of a crisis when COVID-19 hit the economy last year. We lost millions of jobs and we have yet to recover some of these jobs. Yet the Fed believes that doing the same thing over and over again will somehow produce a different outcome. What have we achieved since 2008 from this reckless monetary policy? More homelessness, that's for sure. Reduced purchasing power, that's for sure. Less home affordability, that's for sure. No job security, that's for sure. And you know what else for sure? Propping up the stock and real estate markets to benefit the rich. It is time to end this reckless policy. It is time for the Fed to start tapering now before this morphs into a bigger disaster for this country. All right, rant is over. Let's cover the market, shall we? And here we go. In the morning, the dollar was trading higher and yields were trading higher. This is a lethal combination for the market. Yes, the 10-year yield eased up as the trading session started, specifically after we heard from Bullard, George, and Kaplan. But regardless, the damage was done. The Dow Industrial Average closed down by 192.38 points, or a decline of 0.54%. The Nasdaq closed in the red, down 96.05 points, or a decline of 0.64%. The S&P 500 also closing in the red, down by 26.19 points, or a decline of 0.58%. What about the sector's performance today? Pathetic across the board, and the weakness led by energy, materials, and consumer cyclicals. What about the advance to decline ratio, the market's internals? NYSE 23% advancing versus 74% declining. The Nasdaq 34% advancing versus 63% declining. What about futures? What's going on here? Crude oil prices were down about 1% apiece for both the WTI and Brent. Softs muted across the board with noticeable gains for OJ and lumber futures. Lumber up about 6% today. Metals down across the board with exception of gold. Gold started to rally later in the day as the 10-year yield started to ease up. What about meats? Down across the board. Grains, likewise, down across the board with the notable decliner, soybean oil, down about 2% or so. Meanwhile, the gainers in grains futures were soybean meal and wheat futures, all with substantial gains today. Moving on to the big casino, the options market. What's going on here? The hottest table at number 1, AMC, but I should say that the volume all in all is down. Yet AMC at number 1 with about 700,000 contracts, about 73% of those were calls. And yep, as you guessed, the majority of these calls are expiring tomorrow. At number 2, Apple with about 660,000 contracts, about 67% of those were calls. Tesla, the souffle, at number 3 with about 450,000 contracts, about 55% of those were calls. And notice the elevated volume in calls for the ticker SPRT. This is support.com. The stock was up about over 50% today alone, and they continue to bid for more gains to come. Likewise, NVIDIA elevated call options volume. NVIDIA is pretty much a Ponzi scheme stock right now, being pushed solely based on the call options buying activities. This is a $500 billion plus in market valuation. Over $100 billion were created in the last few weeks alone. What happened? Did NVIDIA double their revenue? It's a great company. It's a growth company, but this is beyond ridiculous. Moving on to the unusual activities that took place in the options market today, starting with the ticker PSTG. This is for Pure Storage. They bought the $20 puts, expiration date November 19th, with expectations that the name will drop by over 16% by then. They paid about 65 cents apiece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker MS for Morgan Stanley? They're bullish here. They bought the 110 calls with the expiration date of September 10th, expecting the stock to rise over 6% by then. They paid about 32 cents apiece to enter this trade. All in all, spending about $500,000 on this trade alone. And here it is, SPRT for support.com. They're betting for more gains by buying the 23 calls, expiration date September 17th, with expectations that the name will add an additional 17% or more by then. They paid about $5 apiece to enter this trade. All in all, bringing the total to about $5 million. What about the trade for the ticker SNAP, Snapchat? Another bullish call here by buying the 80 calls with the expiration date of November 19th. The expectations are for Snapchat to rise by over 12% by then. They paid about $4.50 apiece to enter this trade. All in all, spending about $5 million. Big one. What about the trades? Not trade, but trades for the ticker TXN, Texas Instruments. Now, you can interpret this trade any way you want. You could say it's a strangle, but the way I interpret it is somebody who holds the stock and they're buying some protection here, because this is my interpretation, of course. They sold the 200 calls for the expiration date of November 19th, and they collected about $3.65 apiece in credit. They used some of that credit to buy some protection, in this case buying the 165 puts with the same expiration date, and this has cost them about $2.65 apiece. So all in all, they're actually left with credit of about $800,000. So this is a classic, always a great hedge and protection trade. If you own a stock and you're seeking some protection for volatility, earnings, whatever it is, you sell covered calls, you use the credit to buy some puts out of the money. And this is, of course, my interpretation of this this trade. What about the trade for the ticker LMT? This is Lockheed Martin. I've been talking about this name for a while now. Folks, the President of the United States, Joe Biden, is under a lot of heat right now. He looks weak. He looks pathetic, and the country as a whole looks humiliated on the global stage. America has become a joke, and therefore we know every time a U.S. president is under pressure, political pressure, they do something crazy. Usually, airstrikes, they bomb something. They choose whatever they want to choose, and they bomb it as a distraction, as a restoration of image, and this is exactly what will happen right now. You bet. The Biden administration will do something crazy right now. They will bomb something, whatever it is, and they will use Lockheed Martin jets to do the bombing. And therefore, they're buying calls here on LMT. They bought the 380 calls with the expiration date of September 17th, with expectations that the name will rise higher by over 5% by then. They paid about $1.10 apiece to enter this trade. All in all, spending about $900,000. What about the trade for the ticker CZR for Caesars Entertainment? Now, I used to work in the Las Vegas casino industry. I'm not going to tell you which company, but I'm going to tell you which one is not the company I worked for. And this is Caesars Entertainment, the most garbage company on the strip. Everybody complains about it, but perhaps there is a silver lining here, and the restructuring of the company is paying off. They're buying calls on CZR, specifically the 105 calls, with the expiration date of October 15th. They're betting that Caesars will rally an additional 5% or so by then. The name was rallying today. They're betting for more gains to come, and they paid big bucks for this one. $5 a piece. All in all, spending about $4 million on this trade alone. Lastly, what about the trade for the ticker DLPN? This is for a company called Dolphin Entertainment. You like dolphins? I do, but I'm not going to buy calls on them. But somebody is. They bought the $15 calls, expiration date September 17th, with expectations that the name will rally by over 10% by then. They paid about $1.20 a piece to enter this trade. All in all, spending about $800,000. Moving on to the heat map, what's going on here? As I said, in the morning, the dollar was trading higher. Likewise, yields were trading higher. This is a lethal combination for the market. It doesn't favor the inflation trade. It doesn't favor the disinflation trade of tech and growth. Yes, the 10-year yield eased at the end of the day, and perhaps that pushed some of the growth momentum names a little higher, a little outperformance, but all of this of minute importance. And the reason is we have the Fed's talk, the cabal of central banks. They're not going to meet in Jackson Hole, but they're going to meet virtually, like the digital money they print. And all eyes will be on the speech by Chair Powell. Therefore, we have a little bit of nervousness in the market, and you saw the VIX spiking higher by the end of the day. We have some outperformers here, specifically on the heels of earnings, the likes of CRM, Salesforce. By the way, we talked about this chart weeks ago, that the setup is bullish. You got to buy this stock, CRM. It is undervalued, it is underappreciated. We see stocks like Nvidia, for example, which is almost double the valuation of CRM, Salesforce, but they make a fraction of Salesforce revenue. Of course, Nvidia is growing at a higher rate. That's all understandable. But if we're about to value the market based on Nvidia's valuation, then that makes Salesforce underappreciated and undervalued, and the chart is breaking out higher. Likewise, we have Snowflake also rallying on the heels of earnings. The name was trading down after hours, right after the release of the report, but in the morning we saw a lot of short covering, and therefore the stock rallies higher. Nothing important at all, no theme at all looking at the heat map right now. It all depends on what will happen tomorrow. Out of the mouth of Tool Man. Moving on to charts, starting with the 30 minutes chart of the SPY. We had the impulsive rally higher, the illogical rally on Monday, opening a massive gap in the chart. Okay, and the chart consolidates for a little while, a couple of days, trading sideways. Today, we saw a flush down, a mini one, cutting perhaps half of the gains from Monday, and now we have a double bottom formation. Now, unfortunately, the action stopped before we got the conclusion out of the double bottom formation. Will it hold? Will it not hold? Perhaps the chart was saved by the bell. In any case, I'm watching for the double bottom formation. If it doesn't hold overnight, then we know right away the next target for the algos will be the gap. And if that doesn't hold, then we have 443 for support. This is a daily chart for the SPY, the continuous contract futures. We have a defined trend here. And every time the chart deviated from the trend line by the tune of about 3 to 4%, we saw a pullback and a revisit to the trend line. The chart retags the trend line, it bounces higher, and it continues with the same rhythm of the trend. This is how any healthy trend, any bullish trend works. You cannot diverge from the trend line for too much or too long. The higher the divergence is, the steeper the correction, the steeper the pullback. For now, so far, we're at about 3% divergence from the trend line, which is below average for this trend, but we're getting close here. It wouldn't be surprising for the chart to pull back all the way to the trend line at this point. Usually a trend at the end of the trend, we see these divergences getting smaller and smaller and smaller. In other instances, they get smaller and smaller and smaller, but the last divergence, for example, look back at the trend of August 2020 in the NASDAQ. We see what it's described as the last hurrah rally, where we see a massive divergence from the trend line. Usually, not always, but usually, this is the last piece of the rally. So, are we going to rally higher from this point on in a last hurrah rally? We'll see. But for now, the likelihood is if we pull back from this point on, it doesn't mean that the trend is over, but it means that we're getting closer to the end of the trend because we're pulling back from 3% now. The next pullback perhaps will be at a 2% gains, 1% gains. And sooner or later, the chart gives up the trend line by breaking it. And there you go. This is the end of the trend. What about the Qs? 30 minutes chart. What's going on here? Again, a massive pump higher on Monday, opening a very large gap here. We have some of these gaps that are never filled. For example, the pump from November of last year after the elections. We saw a pop higher opening a gap, and that gap is still here. Who knows, perhaps in the future, when we have a bear market, I know you're laughing, but it could happen. When it happened, we could close the gap from November. Here we have another gap. Will it hold? It will only hold if the Feds hold on tapering. If the Fed says no tapering, then the assumption is the market will blast higher, and this gap will hold for now. But if Powell is persuaded by the school of thought from Bullard, George, Harker, Kaplan, then perhaps they will start talking about tapering, and tapering will happen this year. And if that is the case, then this gap will be closed fast. Again, we're watching the double bottom formation. Will it hold overnight in the futures chart or not? If not, then we know that the gap is the next destination to eye. If that doesn't hold, then we have a support line at around 365.5. What do we see in the chart of the continuous contract on the daily chart for the NASDAQ? A massive pop higher. We're trading way above 15,000 right now. The negative divergence in the RSI is gone. Likewise, the negative divergence in the MACD is also corrected for now. I want to have your attention here, not in the continuous contracts chart, but in the actual Qs, the daily chart of the triple Qs. Here we have a trend that goes all the way back to September of last year. We have massive divergences here of double digits, 19, 12, 15, 10%. The current divergence that we have is about 10%. So once again, slightly below average. But it wouldn't be surprising for the chart to pull back all the way down to revisit and retag the trend line. Folks, this is normal, healthy trend line behavior. The chart cannot diverge from the trend line for too long or too far. The gravity of the trend line will be supreme. And once again, it all depends on the outlook of tapering, which we will get tomorrow. Whether this will be the pullback or are we about to see a last hurrah rally, just like we saw back in September of last year. August, September, the pullback happened in September. The majority of the rally happened in August. We know the catalysts, by the way, the stock splits in Apple and Tesla. Here's a chart of the IWM, the Russell 2000 30 minutes chart. Facing the resistance, once again, of 223. This has to be an extreme level of resistance. The chart fails over and over and over again in breaking that line. We have support at 218. And by the way, watch the formation in the IWM. Many analysts, not including me, but many analysts believe that the IWM is a leading indicator. Ask yourself a question here. Did the double bottom in the IWM hold or did it not? It looks to me, to my eye right now, that the double bottom in the IWM did not hold, and we closed the day below the previous low of the day. Is this a precursor to what's about to happen in the SPY and the NASDAQ? Who knows? All what I know is I have support at 218. If that fails, we're looking at the gap, and if that fails, then the chart goes down all the way to 212. Here's perhaps the most important chart of the day, of the week, of the month, the US dollar. The origin of everything in the market right now, the US dollar. We talked about the cup and handle formation, the cup and handle within the cup and handle, the Christopher Nolan formation. It's a powerful, bullish formation. Yes, last week after Jackson Hole was canceled, everybody assumed that tapering is out of the picture, and therefore the dollar went down. Tapering means less coke in the market. Less coke means a higher value of the dollar because you're printing less and less dollars. But if the printing goes on, then the dollar goes down as more and more coke gets printed. Well, now the market is a little nervous. The market is not sure whether to go with the delayed tapering outlook or whether to listen to Bullard, George, Harker, and the flip-flopper Kaplan. It is bouncing higher right now at a 93. Now, I'm not a seer. The dollar is trading flat overnight as I'm speaking right now. Things will change in the morning. It all depends on what Powell is about to say. Hawkish means higher US dollar. Dovish means a sell-off in the US dollar. And you're adult enough to know what that means. What are the implications, the domino effects, if the dollar goes up or down on gold, on the inflationary stocks, on futures, commodities, tech stocks. Now, I want to visit the chart of the 10-year yield before we move on to gold, because the 10-year yield This is what it looks like right now. We're trading above 1.28%. The chart broken above the descending line of resistance. Is this bullish or bearish? This is bullish. You have a double bottom formation. You have a higher low. And as I shared with you on Twitter, via post, this is also a cup and handle formation. And guess what? We have the Christopher Nolan pattern in yields too. If we zoom out to a weekly chart, we have a cup and handle within a larger cup and handle. And last time we saw that, the cup and handle formation in the chart of yield, the 10-year yield that is, we saw a pop right away of about 32% in the 10-year yield. Will it happen this time around? It could, but remember, this is a weekly chart. It's a long process. It's not going to happen in a day, in a week. It will happen over time. Let's talk about the TLT while we're at it. This is a weekly chart. Still hugging 149, keeping everybody on edge. We have a massive move about to happen in the bond market. Either the TLT will pop higher or flush down. The momentum indicators are starting to suggest some weakness on the TLT. Perhaps the biggest mystery is, what if the Fed tomorrow, via Chairman Powell, says, you know what, tapering will happen. We're not changing anything here due to Delta or any of that. We just canceled the meeting because Delta concerns. But inflation is still rising higher. Nothing changed in our tapering outlook. Will yields crash as they did before when Powell hinted at tapering, meaning the bond market sending a message and saying, you know what, Powell, if you taper now, you're going to crash the economy, and therefore yields go down. Will we see the same response this time around, or will we see the logical response as the bond market starts to face reality that the Fed indeed will taper? And if the sugar daddy who's been buying half of the supply of bonds cease to do so, what do you think will happen? Bond prices go down, yields go higher. It's an inverse relationship. We'll see what happens. But here's gold, and the gold bugs are at no envy here. They're holding their breath, and the reason is tomorrow will be a big day for gold, depending on the movement in the US dollar and yields. Remember, gold has two enemies, the dollar and yields. If both go higher, assuming the bond market finally gives up and realizes that the Fed will taper, dollar goes higher, yields go higher, what do you think will happen to gold? For now, the assumption is we will see gold crashing. The VIX, what's going on here? 4 hours chart. We've been following the MACD indicator on the 4 hours chart because it has been spot on, precise 100%. Every time the MACD crossed, creating green impressions on the histogram, we saw a double-digit pop on the VIX. The last one was over 60% pop. Now we have yet another crossing that happened today, a baby one, still under construction. But if it happens and we see another pop in the VIX, the assumption is the VIX will try, keyword try, to close above 20 for the week. This hasn't happened for a long time now. Fridays in this hypermania market are known as Crush the VIX Fridays. Every Friday, the VIX gets crushed. Why? Because we're living in the upside down market. Nothing makes sense at all. It's a bizarro freak show market, and the rules don't apply anymore. In the past, the VIX goes higher on Fridays as market participants buy insurance and de-risk heading into a weekend. In this mania market, in this hyper bubble market, it's the opposite. The risk is to the upside. Therefore, you see the VIX and volatility being sold heading into a weekend. Why? Because market participants know the market doesn't care about anything at all. Even if a nuclear war happens over the weekend, it will not impact the market negatively at all. If anything, it will impact the market positively as the outlook for Coke becomes more abundant. Apple, what's going on here? This is a 30 minutes chart, again within range. The resistance 150, the support 145. Waiting and waiting and waiting for a break one way or the other, because this is my leading indicator for the market. Apple breaks above 150, then we have a massive rally to come. If it breaks below 145, then you know the SPY, the Qs, will go back to retag the trend lines we just talked about. Tesla, the souffle, what's going on here? 45 minutes chart. The per usual pump on Monday, this time a little bigger than usual. The manipulation in this chart is disgusting, and it's all done via the options market. On Mondays, they pump. On Fridays, they dump. Will they do the same thing tomorrow? We will see. The bulls have a pattern of higher highs and higher lows for now. And if the chart breaks above 720, closes the week above 720, then we have a massive bullish signal. On the contrary, if the chart breaks the trend of higher lows by closing below 679, then we have a big problem in this chart. It will 1,000,000% go down to revisit 629 for support. Tulips, BTC, what's going on here? Again, 50,000, a tough resistance level for BTC. It doesn't mean that BTC will fail at 50,000, but it means that the ABC pattern is already completed. The target has already been achieved. And if you're not taking profits right now, you're just a greedy pig. You gotta take some off the table at least. And the expectations are that BTC will pull down all the way to 42,000 to retest that level for support. What about AMC? What's going on here? Midweek, we saw the pump, the massive pump in GME and AMC of about 20% apiece. We don't have any follow-up here. AMC is trading down, and all of those who got excited by the pump and bought call options, they're getting obliterated. They still have hope that AMC and GME will have a squeeze at options expiration date, meaning tomorrow, but it is a long shot here, and it stresses out what the market has become. An unregulated jungle. Somebody pumps, who knows who, what their goals are, who they're trying to prey on, because it's a market of prey and predator. The prey, in this case the apes, think that they're smart, they got it, they're sticking it to the man, yada yada yada. Meanwhile, the predator, the whales, they pump and dump as they please. They play this game AMC up and down, making money both ways. For now, it appears to be that 45 is the resistance level, and the majority of calls with open interest right now are 45 and above, meaning that market makers will try to keep this chart trading below 45. Of course, to make sure that most of these calls will expire worthless. It's upon retail traders to buy the stock and buy calls to counter that force and push the stock higher. We will see what will happen tomorrow, which side will win. For now, it appears that the market makers are winning for now. And lastly, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have personal income, consumer spending, core PCE, consumer sentiment. It could not be any more important than tomorrow from a macroeconomics perspective. Core PCE, this is what the Fed looks at. If core PCE comes out soft in the morning, the market will lose its mind in a jubilee, popping higher impulsively so, because they will assume that Powell looked at the same data of core PCE, the Fed's favorite measure of inflation, because it suppresses the true nature of inflation. But if it comes out soft, then the assumption is Powell will come out dovish, and this is good for the market. If core PCE comes out a little hot, then the assumption is Powell will come out hawkish, and this is bad for the market. Now, when it comes to consumer sentiment out of the University of Michigan, this will be the final reading, by the way. This is extremely important because last time around, the preliminary reading shook up the market because consumer sentiment crashed. Are we going to have a confirmation here? Or was the panic from the preliminary reading crash overdone? We'll see. And of course, the main event, the speech, the conference, whatever it is, out of the mouth of Fed Chairman Powell. All eyes on the virtual Jackson Hole and the hole on the face of Jerome Powell. And with that, ladies and gentlemen, we're done here. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.